Okay, let's unpack this. Imagine this scenario. You've got like a brilliant trading strategy, right? Everything lines up. Charts look good, indicators, perfect. You've done all the homework,
Hmm.
you place the trade, and bam, it instantly starts moving against you. Or maybe it's going your way, but you're just terrified it's going to reverse any second.
Yeah, that tension.
Exactly. So, in that moment, is it really your strategy failing? Or is it something else going on? There's this phrase you hear a lot: the market doesn't make you lose money, your psychology does.
Well, it's maybe a bit blunt, that statement, but it really does get to the heart of it, doesn't it?
Yeah.
It tells you right away that success in the markets isn't just about analysis. It's deeply tied to how you manage yourself,
Yeah.
your mind.
Right. And that's exactly where we're diving in today. We've
Mm.
gone through your notes, the articles you send on trading semiology, and we've pulled out what seem like the absolute core insights. We're going to try and dig into why mastering your own mind might just be the most crucial thing for consistent success in trading.
Absolutely. The sources we looked at really hammer this point home. There's even that 80-20 rule idea floating around.
Oh, yeah.
The idea that trading success could be like 80% psychology and only 20% strategy. Now, you could argue about the exact numbers,
Sure, sure.
but the core message is pretty clear. Psychology often ends up being the dominant factor.
Okay, but why? Why is psychology so much more important than, say, having a really solid, well thought out trading plan? Isn't the plan kind of everything?
The plan is vital, no question, absolutely essential.
Yeah.
But your ability to actually execute that plan,
Yeah.
especially when things get stressful or you get too excited, that's all psychological.
Ah, okay.
Think about those classic emotional pulls,
Yeah.
fear and greed. Fear can make you jump out of a perfectly good trade way too early, right? You leave money on the table.
Definitely seen that happen.
And greed,
Yeah.
well, greed can make you hold on to a losing position for far too long, just hoping, praying for a turnaround that maybe never comes. And that turns a small, manageable loss into something potentially disastrous for your account.
Yeah, I can see that. And the sources also mention just the difficulty people have handling losses, period, that sort of deep-seated need humans have to be right, how that drives bad choices, and just a lack of consistent discipline. These are all internal battles, aren't they?
They really are. Trading psychology, fundamentally, is looking at how our emotions, our mental state, how they impact our decisions and our behavior when we trade. It's admitting that emotions aren't just static in the background.
Right.
They're active forces. They can completely sabotage even the best strategy, leading to impulsive, irrational moves.
Loss aversion.
Mm.
That feels like a really big piece of this puzzle. That just a horrible gut feeling when you have to admit you were wrong and actually take a loss, even a small one.
It's incredibly powerful. It really is. Our brains are basically hardwired to avoid pain, and realizing a loss registers psychologically as pain.
Mm.
So resisting that initial smaller pain that often leads traders to just wait, hoping the price might come back, only for it to keep going against them, leading to much bigger, much more painful losses down the line.
Yeah.
On the flip side, these successful traders, based on these materials, they show traits like unwavering discipline, incredible patience, resilience when things go wrong,
Staying calm under pressure.
staying calm when everything feels chaotic, exactly. And crucially, they base their decisions on objective logic, on their plan, not on how they feel right then and there.
Yeah.
Discipline keeps them following the plan. Patience lets them wait for the genuinely good setups.
Okay, so how do we actually cultivate that kind
Well,
of mental strength? This brings us to people like Mark Douglas. His work seems pretty central in the sources. And his own story is kind of interesting. Apparently, he lost a lot early in his career,
mhm.
not because his analysis was bad necessarily, but because his mindset was off. And that experience pushed him to really explore the psychological side of things.
Yeah, Douglas became a really influential figure in this whole area, especially with his book, Trading in the Zone. His core concept, the foundation really, is what he calls thinking in probabilities.
Thinking in probabilities. Okay, my first reaction is that sounds straightforward, but it feels totally counterintuitive to how we usually operate day to day, right? We want guarantees, certainty.
Absolutely correct. And that desire, that craving for certainty, it's lethal in trading. Douglas argues you simply have to accept that you can never, ever know with 100% certainty what's going to happen next on any single trade. Losses aren't personal failures. They're just a statistical reality of playing the game.
So just internalizing that uncertainty, that's like the first step to calming down the emotional roller coaster.
Precisely. When you stop needing to be right on this specific trade and you start seeing each trade as just one event in a much larger series of probabilistic outcomes, well, the emotional sting of a loss really shrinks. dramatically.
Okay.
And that mindset shift, it shields you from those really destructive reactions, like panic selling just because a trade ticked against you, or revenge trading,
Yeah.
where you jump right back in after a loss, trying to win the money back instantly. It also helps prevent that kind of paralysis you can feel after a few losses in a row, where you hesitate on a perfectly valid setup just because you're scared to lose again.
Right. It shifts your focus away from the unpredictable outcome of this one trade towards consistently executing your process over many trades.
Exactly that. You develop trust that if your process, your strategy, has a genuine statistical edge, then executing it over and over again will lead to positive results over time, even if the individual wins and losses feel completely random in the short term.
And this idea seems to be the foundation for what Douglas called the five trading truths. The sources really emphasize these aren't just concepts to understand intellectually. You have to kind of absorb them, internalize them deeply.
Yes, absolutely. These five truths, they're like the bedrock for building that probability mindset. The first one is pretty blunt: anything can happen. No matter how perfect a setup looks, how confident you feel, any single trade can still lose. You could have a strategy with a 90% win rate historically, but your very next trade could easily fall into that 10% losing bucket.
Right.
And maybe even harder to swallow is that you can have several losses in a row purely because of random distribution, not because you suddenly started doing something wrong.
Oof, yeah, that would feel like a real gut punch if you're expecting a win just because you had a loss before it.
Okay, what's the second truth?
The second truth is you don't need to know what will happen next. This one is actually incredibly liberating when you grasp it.
How so?
Because your success doesn't depend on having some kind of crystal ball for every single trade. It comes from consistently executing a strategy that has a positive expectancy, an edge that plays out over time across a large number of trades.
Okay, so let go of the need to predict the future on each trade. Got it. Truth number three. There's a random distribution of wins and losses. Even when you have a genuine edge, your short-term results will look random. A winning streak doesn't suddenly mean you've cracked the code and will never lose again.
Right, keeps the ego in check.
Exactly. And conversely, a losing streak doesn't automatically mean your strategy is broken or the market is suddenly out to get you. It's just random noise in the short run.
That helps avoid despair during drawdowns too, I imagine. Okay, number 4.
Number four, an edge is just a higher probability. It's not a guarantee of winning on any specific trade. It just means that over a large sample size of trades, the odds are tilted slightly in your favor. This really reinforces why you have to focus on the long-term application of your edge, not individual outcomes.
Makes sense. And the 5th, the final truth.
Every trade is unique. Or maybe, better put, every moment in the market is unique. The market is constantly changing, dynamic. You can't make today's trading decisions based on the emotional baggage, the fear from yesterday's loss, or the overconfidence from yesterday's win left over from past trades. Each setup needs fresh eyes, evaluated on its own merits right now.
Wow, internalizing those 5.
Mm-hmm.
Yeah, that really does sound like the absolute foundation you need for building emotional resilience in trading.
It really is. And that resilience, that mental toughness, it's nowhere more critical than when it comes to risk management. Specifically, setting and actually honoring your stop losses. The
Yeah.
sources make it crystal clear that risk management isn't just some technical setting on your platform. It's deeply, profoundly psychological.
I've heard so many stories and honestly seen it myself. Traders struggle so much with stops, moving them further away, taking them off completely, or just not setting one in the first place. Why is that mental commitment, accepting the potential loss before you even enter the trade, why is that so vital?
Because once you're in the trade and it starts moving against you, your emotional state shifts dramatically.
Mm.
If you haven't truly, fully accepted the possibility of that loss beforehand, then when the price gets near your stop, fear kicks in, hope kicks in, hope that it might just turn around.
Right.
And that fear and hope completely overpower logic. Your brain is screaming, don't take the pain, avoid the loss. So you rationalize moving the stop just a little bit further, or maybe getting rid of it altogether, which more often than not just leads to a much bigger, much more painful loss later on.
Okay, so what does it actually mean then to genuinely accept the risk? It feels like it has to be more than just sort of nodding and saying, yeah, okay, I could lose this money.
Oh, it's absolutely deeper than that. It really starts with position sizing, only risking an amount of capital on any single trade that you are truly emotionally okay with losing.
Okay.
If hitting your stop loss causes you physical tension, like a knot in your stomach, or significant emotional distress, your position size is probably too big for your current psychological tolerance.
Yeah.
That's a key sign.
That makes sense.
And it also means mentally committing to that stop-loss level before you click the buy or sell button. It's like making a pact with yourself. If the price hits this level, I am out, period. And I am genuinely okay with that outcome. It's just the cost of doing business while executing my edge.
That idea of mental rehearsal before the trade even happens, that sounds powerful.
It is. And it also involves trying to view the market impersonally. It's not targeting you. It's just probabilities playing out. And, crucially, taking 100% responsibility for your results. No blaming the market, your broker, or some news event. It's your trade, your outcome. When you manage to internalize this level of risk acceptance, you create a kind of emotional detachment. It allows you to analyze the market much more objectively, make decisions based on your plan, not your fear, and maintain consistency even when things get stressful. There's that quote from Douglas again. When you truly accept the risk, you will be at peace with any outcome. That's the state you're aiming for.
Wow, yeah. That quote really nails it, doesn't it? The psychological battle is essentially won or lost before you even place the trade, not while it's active.
Precisely. And this whole idea flows directly into the 7 principles Douglas laid out for achieving consistent trading profits. You can think of these less as just trading rules and more as psychological disciplines for effective execution.
All right, let's break these down. Principle number 1.
Know your edge. You need to understand clearly and objectively what your statistical advantage is in the market, what specific conditions give you a higher probability of success over time. Having this defined gives you objective entry criteria and helps remove emotional gut feel decisions.
Okay, makes sense. Principle 2.
Define risk before every trade. Determine your maximum acceptable loss before you enter. Pre-committing like this puts a hard boundary on your potential downside. It prevents those impulsive in-the-moment decisions to risk more than you planned when a trade starts going against you.
And principle 3 sounds like a direct follow-on from our risk discussion.
Exactly. Fully accept the risk before entering. It's so important. It gets its own principle. You have to build that emotional resilience to the possibility of loss before you put capital on the line.
Okay. Principle 4. Does that tackle the hesitation problem we mentioned earlier?
It does. Act on your edge without hesitation. When your predefined trade setup conditions are met, you execute immediately. No second guessing because you just had a loss or because you're feeling fearful. Hesitation not only costs you potential profits, but also undermines your confidence in your system.
Principle 5 seems a bit more flexible.
It is, in a way. Take profits as the market makes them available. This means don't impose rigid, perhaps unrealistic profit targets onto the market's behavior. Be adaptable. While having initial profit targets is usually part of a good plan, you should also be prepared to take profits if the market offers them clearly, even if it's slightly short of your ideal target. It's about balancing discipline with market reality.
Okay. Principle 6 turns the focus inward, right?
Absolutely. Monitor yourself for emotional mistakes. This requires metacognition, basically, the ability to observe your own thinking and feeling while you're trading.
That sounds hard.
It is. And the sources strongly recommend using a trading journal for this. Not just recording the trade details, entry, exit, stop, variant, but also noting down your emotional state. How did you feel before, during, after? How might those feelings have influenced your decisions? This self-monitoring is absolutely crucial for identifying and correcting your psychological weak spots.
Makes sense. And the final principle, number 7.
Stick to the rules without expectation. This means follow your trading plan consistently, execute your edge, manage your risk according to your rules, but detach yourself emotionally from the outcome of any single trade or even a short series of trades. This transforms discipline from something you have to constantly force yourself to do into more of an automatic habit. And it reduces the immense pressure that comes from expecting or needing every single trade to be a winner.
It really sounds like these 7 principles, if you actually practice them consistently, they kind of automate the very discipline that most traders seem to struggle with on an emotional level.
That's the goal, definitely. And the sources also mention other practical tools that really support all this psychological work.
Right.
Developing a comprehensive trading plan is obviously paramount. It's your rule book, right? It details your strategy, your risk management rules, your entry criteria, your exit criteria, everything. It acts like an external anchor to keep you grounded and prevent impulsive emotional decisions, especially when the market gets volatile. And it's not static. It needs regular review and adjustment as you learn and evolve.
And then there's setting realistic goals.
Yeah.
That came up too.
Hugely important, yes. Using SMART goals is often recommended: specific, measurable, achievable, relevant, time-bound, setting unrealistic profit targets, or expecting to get rich quick. That's just a fast track to frustration, desperation, and inevitably breaking your rules. The focus should really be on consistent execution and diligent risk management. If you do that well, the profits tend to take care of themselves over the long haul.
And the trading journal you mentioned, that seems central to the self-monitoring part.
It's invaluable, truly. A detailed journal where you log the trade specifics, the setup rationale, and critically, how you are feeling. It helps you spot those recurring patterns in your emotional responses. You can clearly see, looking back, where your psychology might have pulled you off your plan.
And that links to the idea of routine self-reflection.
Yes, exactly. Actually setting aside time regularly, daily, weekly, whatever works, to review your journal, review your trades, review your performance, and ask yourself those tough questions. What emotions were driving my decisions here? Did I hesitate? Did I act impulsively? Why? This conscious analysis is absolutely essential for continuous psychological growth.
And finally, visualization techniques were mentioned. How do those fit in?
Visualization is essentially about mental rehearsal. It's about conditioning your mind for the behavior you want to exhibit. So, by repeatedly visualizing yourself, calmly executing your trading plan, accepting a stop loss without any emotional drama, sticking to your rules even after a losing trade, you start to build those neural pathways. It builds confidence. It can reduce anxiety by making successful, disciplined actions feel more familiar, and it reinforces the positive habits you're trying to establish.
You know, this whole deep dive, it really underscores that trading isn't just about looking at charts and crunching numbers. It's a profound exercise in, well, self-mastery, isn't it?
It absolutely is. And, while we've been focusing specifically on the high-stakes environment of trading, these psychological principles we've discussed, they have much, much broader
Oh,
applications.
yeah, that's the connection back to you, the listener, right? Whether you're getting ready for a crucial presentation at work, navigating a complex negotiation, making significant investment decisions outside of active trading, or even just trying to manage your own reactions to uncertainty in everyday life. These lessons from trading psychology are incredibly relevant.
You could almost see trading as a kind of high-speed, high-pressure laboratory. This place where you can really study how our minds handle risk, how we deal with uncertainty, and how we manage those powerful emotional impulses.
So I think the key takeaway seems pretty clear. Mastering trading psychology, really understanding your own emotional triggers, learning to accept uncertainty and risk up front, and actively building disciplined execution through tools like a trading plan, a journal, and truly internalizing those core truths and principles we talked about. It's just as critical, maybe even more critical than mastering any specific trading strategy itself. It really comes down to mastering yourself.
It really does. It starts and ends with self-awareness and consistent discipline.
And maybe here's a final provocative thought for you to mull over. We've seen how vital it is in trading to accept uncertainty, to focus on the process rather than fixating on the outcome of any single event, and to manage your emotional reactions, especially to potential losses. So, where else in your life might these exact same principles unlock new levels of performance, or maybe just greater peace of mind? Think about goals you're pursuing, challenges you're facing, important decisions on your plate. Could adopting a more probabilistic mindset, genuinely accepting potential downsides beforehand, and rigorously sticking to a sound process, regardless of those inevitable short term bumps, be a game changer for you, even far away from the financial markets?